In Module 4 of your book, we deal with financial statement analysis, and I'm going to break this video into two parts. One, we'll go over the major um, ratios. When we say financial statement analysis, we're primarily talking about using ratio analysis. And so I'm going to go over the major ratios that we use in this first video, and then in the second video, I'm going to work on some of the problems from this chapter. So there's a number of big ones that we have, and then your book gets into some operating ratios. Let me see. Well, probably, yeah. Probably learning objective 4-3 on that, that we don't really need to get into, or 4-4 on that we don't really need to get into. That gets pretty detailed, and so I won't hold you accountable for that for the exam. So anyway, let's take a look at the major ratios that we have to deal with. The first one is return on equity, often abbreviated ROE, return on equity. And when we say return, we're talking about income, generally speaking. And so it is simply the income, net income, if you will, divided by the average equity of a firm. Okay, so that's just basically all there is to ROE, the general ROE. However, the term ROE is generally geared for the common shareholders. And so what we have to do, in most cases, what we need to do is we need to adjust this formula in order to take out the preferred equity effects on that. So if we do the if we have common shares, the ROE is going to look like this. It's going to be the income, net income, minus the preferred dividend. Now, we haven't talked about preferred dividend, preferred stock yet, at least not in depth. But preferred shareholders get a dividend before common shareholders can receive a dividend. Now, there is no legal obligation to pay the preferred dividend. Generally, what happens if they don't pay the preferred dividend for 3 or 4 years, then the preferred shareholders start getting a vote on management at the annual meeting. But there's no legal obligation. If they don't pay it, there's nothing they can do as long as they're not paying common shareholders either. And then we're going to take the average equity minus the average preferred equity. Now, generally speaking, preferred equity is a pretty small part of shareholders' equity when we look at it. So it will affect it when we take that out. Now, let me talk a little bit about this average equity. Average equity is not too bad a term. We'll get to one later on where we take the average, when we get the average for receivables and payables That one's got some problems, which we'll talk about at the time. But um, average equity is simply your beginning equity at the beginning of the year or last year's ending equity plus this year's ending equity divided by 2. That's how we get the average on that. So that's how we do that. Now, as it turns out, um, this ROE can be somewhat disaggregated, right? And so the way we can do that is that we can have a term, and this is also a very common one. In fact, when you get into your next accounting class, 6302, return on assets is one of the common ways to um, value or to evaluate um, mid and upper level management, depending on what their segments are. So return on assets are simply the income divided by average total assets. And again, take the beginning assets plus the ending assets, divide it by 2. And again, that is usually not. These are net assets, so like it would be the book value type thing. But it's the total assets, average total assets, and that's our return on assets. And again, a very popular way of evaluating people. And so then another thing we have is financial leverage. And now there are 2 types of leverage in business. There's financial leverage and there's operating leverage. If you were to get me for 6302 in the fall, I talk a lot about operating leverage. I don't know if every instructor does, but financial leverage is what most people think about. You borrow a lot of money, you're highly leveraged, right? And so, what financial leverage is simply your total average total assets divided by your average total equity. Okay, so so that gives you your financial leverage, and so obviously, the more we borrow, the more debt we have, the higher this number is going to be. You know, if I operate with almost no debt, this number will be close to 1, just a little over 1. If I operate with a lot of debt, this number may go up to 3, 4, 5. And of course, you know, leverage is if you bet big and win big, leverage is great. And if you're on the wrong side of things when the economy goes bad and you're highly leveraged, you can go out of business. You know, leverage can make you rich, or it can put you in the poorhouse. So it's just a multiplier, really. So now, if we go back and look up here at ROE, this first ROE, the ones where we either ignore the preferred shares or don't have any preferred shares. A lot of companies don't have preferred shares. So if we look at the ROE, then that's going to equal income divided by average equity. But that is also going to equal ROA, which is income divided by average total assets times financial leverage, which is average total assets divided by average total equity. So just a little algebra, those cancel out, and we have income divided by total equity. So it's a way of disaggregating and seeing how much of our return on equity is based on leverage and how much of our return on equity is based on this ROA, the return on assets. Now, we could have it is conceivable that we could have a fairly low return on assets, but if we were highly leveraged enough, that would turn out to a good ROE. That's probably a little dangerous, but it is perfectly conceivable that can happen. All right. So what happens though if you want to use this one, this ROE? So we end up with the same thing. The ROE is going to equal the income minus preferred dividends, divided by average equity times or minus average preferred equity and that's going to equal our ROA, ROA times our financial leverage, okay, times what we're going to call the non-controlling interest ratio, NCIR. Okay, so the NCIR is simply the income to common shareholders, which is simply the net income minus the preferred dividends, divided by net income, all of which is divided by equity due to common shareholders divided by total equity. And that will give you a number. Now, equity due to common shareholders is just the total total equity minus the preferred shareholder equity. So it's fairly, if you have a balance sheet or a statement of shareholders' equity, it's fairly easy to dig out. So if you have an income statement, they're going to show that statement to common shareholder, income to common shareholders. Because when we create, GAAP requires when we create an income statement, we'll show the net income and then we show the net income to common shareholders. So it's not something you have to calculate. You could very easily, but it'll be there fairly easy. So that's just how you get this second ROE by disaggregating that kind of stuff. All right, so those are the profitability ratios that we normally deal with. Next up comes the productivity ratios. And for the productivity ratios, we've got the gross profit margin. So if you remember on our income statement, we've got sales minus cost of goods sold equals gross profit. Oops. Okay. And so then we come on down here, minus selling and administrative expenses gives us operating income, minus taxes gives us net income. Now that's a fairly simple one. But if you'll just think about that structure of the income statement, our gross profit margin is how much we make on sales, right? So gross profit margin is simply our gross profit divided by our sales. Right? So that's one of the primary things. Now, what that tells us, and nobody really talks about this when they're teaching accounting. A few people, I'm sure, do, but gross profit tells you, are you selling for enough? Net income tells you, are you selling enough of it? Right? Because you're having to cover all this overhead. And so gross profit's a very important metric we have. Then we have another one called the operating expense margin. Okay, so this is our operating expenses, selling and administrative expenses. Sometimes they're called SG&A, selling and general. I think your book called it selling and general administrative expenses, but these are just our operating expenses. This is all the stuff that doesn't go, it's the accounting department, it's the shipping department, it's the janitorial crew, it's the VP of sales, it's the marketing department. It's all that overhead that is, whether we like it or not, is necessary to run a business. We can't get by without it. Right now, admittedly, we'll want to keep it as low as possible and still functioning at a high level, but we cannot do without overhead. It's just impossible to happen. And so the operating expense margin is simply your selling, general, and administrative costs divided by your sales. Okay, so that's that. And then you have your the next one that we have is the days inventory outstanding. And so that is just 365 to represent the days inventory outstanding. So we're going to go to average inventory divided by, this is times, divided by cost of goods sold. Let's see, cost of goods sold. All right. So now we're going to have to, the cost of goods sold we get off the income statement. The average inventory, again, like we do all the averages, it's going to be the beginning inventory, which is last year's ending inventory, and this year's ending inventory. Add those together, divide by 2, we get the average inventory. Great. This is one of those that there's a problem. Why? Because let's take a retailer like Dillard's or Walmart or somebody like that. So much of their sales comes, and most retailers, their fiscal year ends somewhere at the end of January, either January 31st or the third week of January or something like that, right? Because that allows them to book their Christmas sales and have enough time to get all the returns back in so they know what really happened, right? And so they're going to take their inventory. Is their inventory going to be high or low vis-a-vis the whole year? Well, most of them are going to be pretty low. If you're a retail store, your inventory is going to be pretty low after Christmas, the season. And so this average inventory number is often a little bit misleading in some industries, not every industry. Car dealers are the same way. Car dealers are for a little bit different reason. It's not that their big sales are at Christmas, although they do have a little bit of a sales bump at Christmas time. Car dealers, it's because though if those cars are sitting on their lot, they have to pay property tax on them, even though they're inventory. And so they want their inventory as low as possible so that they pay as little property tax as possible. In Texas, we have county and city property tax. In some states, they have state, county, city property tax. So, this inventory number may be a little bit misleading on that. And then the next one we have is the days sales outstanding. Again, days, we're going to have 365 times the average accounts receivable. Now, it's interesting to me that most people in accounting abbreviate accounts receivable AR, but they don't abbreviate accounts payable AP. Some do, actually, but most don't. So average accounts receivable, and that is divided by the sales. And we multiply it times 365, and that gives you the days sales outstanding. So again, average accounts receivable could be a little bit misleading because you're talking about the end of the year. Again, not every industry that's going to be true, but in some industries, those accounts receivable could be a little bit misleading because of that year end. A lot of businesses have their fiscal year end shortly after their busiest season. So like a ski resort up in Utah or Colorado is going to run a fiscal year that ends probably in April, maybe March, but probably April, right? So the ski season is over with, all that kind of stuff. A fishing season, if they're strictly a fishing camp, they're probably going to have their season over in September sometime. They get there maybe early October. They get those last Labor Day visitors in, and that's good. So this average accounts receivable, average inventory could be a little bit misleading on that. Then we have the days payables outstanding. So here we're looking at money we're receiving, payables outstanding. We're looking at what we're throwing out. Again, days is going to be 365, and this will be times the average account payable divided by the cost of goods sold. All right. And so with these three, we can create another number, which is known as the cash conversion cycle. And the cash conversion cycle is simply our days inventory outstanding plus our days sales outstanding minus our days payable outstanding. That would be the cash conversion cycle. So that's the difference between when we buy something and pay for it and we get it. And so how long does it take us to convert our purchase into cash from a sale? That's an important one. This is the one that merchants, ideally think about the way business works versus, especially like a retail business. It doesn't work in the wholesale, in business to business, but think about a retailer like a Walmart. When they buy a good, obviously they just bought one of the TV brands, but so it can't be something that they own. That doesn't work. But if they buy a Samsung TV, they're going to have 30 days to pay for it, right? And it's entirely possible that if they can sell it quick enough, they'll have the cash before they actually have to pay for the good. And that's why, Walmart, we think about a retailer and all that stuff, but Walmart is heavily invested in technology so that they can keep this cash conversion cycle as quick as possible on that. Okay, so that is our our operating ratios that we will worry about. And then finally, I think I got one here. We're going to do our leverage or our ratios. And there's two that you will be responsible for. The first is debt to equity. And it is just what it says, total debt to total equity. Now, if you go back over here, you can see that you can see that this leverage ratio that we did, assets to equity, if you think about it, assets to total equity, because this total equity, that should be average, sorry. You can see that this total equity is what we do here, but then the total, remember that assets equals liabilities plus owner's equity. So assets is debt plus equity, right? Whereas debt is just, so these two will be related, will be closely related. As a matter of fact, if you know one, you can generate the other, right? So that's one of the leverage ratios. And the other one that we have is times interest earned. Now, in order to understand this ratio, we're going to have to get a little bit into tax. As you know, dividends are not deductible to the corporation. That's a repayment to the owners. They are taxable to the owners when they receive it. They are the income was taxable to the corporation, and when they pay it again out to the shareholders, it is taxable. You literally get a double taxation on income from corporations. Debt, however, is deductible. So if I make an interest payment, I'm allowed to deduct that from my from my operating income to get to my taxable income, right? And so times interest earned uses a metric called EBIT. And you'll hear a couple of these, but it sounds a little similar. EBIT is simply earnings before interest and taxes. Earnings before interest and taxes, EBIT. There is one closely related to this. We don't get into it here, but we will eventually, is EBITDA, EBIT. DA. So the EBIT is the same, earnings before interest, taxes, depreciation, and amortization. And why do we get into that is when you get into EBITDA is because depreciation and amortization are non-cash expenses. The fact that I have an expense is not related to when I pay for it. So, for example, I go out and buy a piece of machinery. I depreciate it over 5 years. If I borrow the money for it, I can borrow money all sorts of ways. I can buy it like you buy a car loan where I'm paying off part of the machinery every year, just like a car loan does, or I can do it like on a bond where I just pay interest every year and then pay the whole thing back at the end of 5 years. I can do it that way. I can pay cash up front for the machine. And so the expense of depreciation has nothing to do with when I incur the depreciation expense. And so this is EBIT, DA, EBITDA. And then in the accounting profession, some people will refer to it earnings before I tricked accountants. So it's one of those that's often used by kind of shaky people that don't understand that while depreciation is a non-cash expense, it is still a real expense. I have been in presentations where people go, oh, don't worry about the loss. It's all due to depreciation. Well, you got to pay for that sometime. You may have not pay for it this year. You don't have to pay for it next year, but sometime you paid for that. So the loss, even if it's due to depreciation, is still very real. All right. So let's go back up here to times interest earned. This is going to be EBIT, earnings before interest and taxes, divided by interest expense. And that's net interest expense. So those are the ratios that you need. So our operating ratios, our liquidity ratios, and then our profitability ratios here. And if you know those, you'll know everything I expect from you. So this will stop this one, and I will get into some of the problems in the next video.